Right now, JPMorgan Chase is sitting on something like $40 billion in excess capital.
Yeah, which is just a staggering amount of cash.
It really is. And how the architects at the top of that institution choose to deploy that mountain of cash, well, it's going to dictate the future of global artificial intelligence, the remilitarization of international borders, and honestly, ultimately, the interest rate on your mortgage.
Absolutely. It touches everything.
Right. So today, we are opening up the raw, unfiltered blueprints of the global financial system. Welcome to the deep dive.
And for this one, we are looking at a highly detailed, recent three-part Q&A session with JPMorgan Chase's top executives.
Yeah.
Specifically, we're talking about CEO Jamie Dimon and CFO Jeremy Barnum.
And I think it's important to note right off the bat, these transcripts they're far more than just dry banking metrics, right?
Oh, for sure. They act as a real-time schematic for where trillions of dollars are actually moving across the global economy.
Exactly. So our mission for this deep dive is to extract the most critical insights from those conversations. We're going to decode everything from the pragmatic reality of their AI investments to the massive restructuring of international trade.
And most importantly, translate what all of this high-level financial engineering actually means for you.
Yeah.
But just to set the parameters for this analysis early on, we are going to maintain a strictly neutral analytical lens here.
Right, because these guys get into some pretty heady stuff.
They do. These executives are navigating heavily debated global issues. Massive government deficits, defense spending, sweeping regulatory overhauls.
Right.
So we aren't here to endorse their viewpoints or, take a political stance. We're here strictly to unpack their logic, examine the mechanics of their decisions, and explain the downstream impact on the broader market.
Okay, let's climb straight into the engine room then. Because right now, the sheer velocity of capital moving through this bank it's just staggering.
It really is. The overarching theme in these transcripts is that the market is in an aggressively risk-on state right now.
Risk on, okay.
Yeah. The executives detailed a massive surge in investment banking, which is largely being fueled by high-profile IPOs and some incredibly complex dynamics across Asian markets.
It's kind of like a risk-on market is sort of like an all-you-can-eat buffet, right? The investors are these starving patrons, and the bank is just desperately trying to cater to everyone without running out of food or taking on way too much liability.
That's a perfect analogy. And to quantify that heat, the buffet line is moving so fast that they actually revised their full-year guidance for net interest income, or NII, upward, from $95 billion to $96.5 billion.
Okay, let's unpack this, because a $1.5 billion upward revision midway through the year is a crucial signal.
It is, because net interest income at its core is just the spread between what a bank earns on the loans it issues and what it pays out to depositors holding money in their accounts.
Right.
So when a bank revises that number up by over $1 billion, it reveals a structural shift in how cash is actually behaving in the economy.
And this massive jump is largely being driven by unexpectedly strong deposit balances, right? Like both consumers and massive corporations are just parking way more cash at the bank than their internal models predicted.
Yeah, exactly.
Let's focus on the mechanics of that corporate side for a second, because the CFO specifically mentioned the booming data center industry as a huge driver here.
They did, yeah.
He said that in wholesale banking, loans are essentially creating deposits. How exactly does a loan for a data center artificially swell a bank's deposit base?
Well, it really comes down to the staggering scale and the timeline of AI infrastructure. Because building a state-of-the-art data center is highly capital intensive.
Oh yeah, billions.
Right, so a tech company might secure a $1 billion credit facility from the bank to fund the project. But they don't spend that $1 billion on day one.
Oh, I see.
Yeah, they draw down the loan, and that cash just sits in a JP Morgan corporate deposit account for months. They have to secure real estate, negotiate with utility companies for power, wait for shipments of NVIDIA server racks.
Right, it takes forever to actually build the physical thing.
Exactly. So the loan originates the capital, but the physical, logistical delays of building the infrastructure mean the cash just sits there, which artificially boosts the bank's wholesale deposit numbers.
Wow, so the bank is essentially earning yield on the very money they just lent out simply because the physical world can't build data centers fast enough to spend it.
Basically, yes.
And surprisingly, this influx of cash isn't just happening with tech giants. Despite interest rates remaining high, which, usually prompts average consumers to pull their cash out of checking accounts and chase higher yield.
Right, in money market funds.
Exactly. But despite that, the bank is seeing incredibly incredibly robust net new checking account growth on the retail side, too.
And they are leaning into this momentum aggressively. The bank reiterated a highly ambitious goal to capture a 15% retail market share in deposits.
15% is huge.
It's massive. And achieving a 15% footprint in such a highly fragmented banking system requires massive physical and digital infrastructure.
So they're building out new branches.
Yeah, they are pouring capital into building out new branch networks in specific geographic strongholds, expanding those primary banking relationships to act as a permanent anchor for consumer funds.
But managing that kind of influx, I mean, it feels less like traditional banking and more like acting as a massive shock absorber for all this global market exuberance.
It really does. The market is just flooding them with capital, demanding complex investment banking services, and the bank has to process all of that volume without taking on toxic liability.
Which brings us to a harsh reality of operating at this scale, the cost of winning.
Yes, the expenses.
Right, because when you are generating exceptional, record-breaking returns, your expenses scale right in tandem. They actually bumped up their expense guidance for the year by $2.5 billion.
And understanding the composition of that $2.5 billion is critical because it's not just, unchecked corporate bloat.
Right.
The CFO was very deliberate in explaining that $1.5 billion of that increase is already booked as a direct variable expense. It's mathematically tied to their capital markets division, outperforming revenue expectations by an astonishing $6.5 billion in the first half of the year.
Wow. Yeah, I mean, if your trading desk does double the volume of trades, your clearing costs, your execution fees, your commission structures, they naturally skyrocket. It's the unavoidable tax on outperformance.
Right.
But the remaining $1 billion of that expense increase is where the future of the bank is actually being built, specifically in technology.
Right. They are throwing immense resources at artificial intelligence.
Yeah, the transcripts reveal they're tracking roughly 1,000 different AI use cases across the firm. But they're really funneling their capital into 50 hypercritical applications spanning risk modeling, fraud detection, marketing optimization, and deep document analysis.
And the way they're managing the cost of this technological rollout is fascinating. The CFO introduced a concept he called token expense.
Token expense?
Yeah. It refers to the cost of pinging commercial AI models through APIs. So every time an employee or an automated system queries a large language model from a major tech provider, the bank pays a microtransaction fee.
Right, often calculated by the token or like a fragment of a word.
Exactly. Right now, Barnum noted this token expense is trivial in the grand scheme of their budget. But they are modeling for it to accelerate exponentially as AI gets deeply embedded into daily operations.
Because of that looming acceleration, they're being ruthless about resource allocation. They emphasize a strategy of matching the exact right model to the right job.
Right, you don't need a sledgehammer for a nail.
Exactly. Like using a massive proprietary top-tier AI model just to summarize a 100-page analyst report is like hiring a premium corporate law firm to read your monthly water bill.
I mean, it gets the job done, but it's a catastrophic waste of money.
Right. So instead, they are utilizing cheaper open source models for routine summarization and reserving those expensive high compute models for complex predictive risk and fraud detection.
And that strategic deployment of AI leads directly into one of the most compelling philosophical arguments Diamond made during the Q&A.
Oh, about the profit margins.
Yes, he directly addressed the prevailing market hype that AI is going to create unprecedented permanent profit margins for massive corporations. He pushed back hard on the idea that eliminating massive swaths of manual labor will suddenly push a bank's profit margins up to 80%.
Okay, wait. If a machine does the work of 30 people in a fraction of the time, and the bank no longer has to pay those 36-figure salaries, healthcare, and bonuses, how does the bank not just absorb that massive operational savings and pocket the difference forever?
Well, in a vacuum, the bank absolutely would pocket the difference. But Diamond's argument is rooted in the brutal reality of capitalist competition.
How so?
He pointed out that if technological efficiency simply equated to permanent profit, bank margins would already be at 80% today, just purely from the transition from paper ledgers to mainframes, and then from mainframes to cloud computing over the last 3 decades.
But margins haven't permanently spiked.
Exactly.
Because the bank doesn't operate in a vacuum. Goldman Sachs, Morgan Stanley, hyper-agile fintechs like Stripe, and PayPal, they are integrating the exact same AI capabilities at the exact same time.
Precisely. When the entire financial sector experiences a massive leap in efficiency, competitive dynamics take over.
Right.
If JP Morgan tries to hoard the savings from AI as pure profit, a competitor will just use their own AI savings to lower their transaction fees, offer better yields, or build a faster product to steal market share.
So to defend their 15% retail market share, JP Morgan will be forced to lower their own prices.
Yeah. Therefore, the ultimate long-term beneficiary of AI-driven efficiency isn't actually the bank's bottom line. It is you, the customer. The market forces the banks to bleed those operational savings back into the economy just to survive.
Man, that is a phenomenal reality check on the current tech euphoria. It completely reframes AI from being this magic profit multiplier into just, the new baseline cost of doing business.
Exactly.
So if AI isn't going to artificially inflate their margins forever, how does a global financial institution actually plan to deploy its massive reserves? We established earlier, they have roughly $40 billion in excess capital sitting on the books.
Right. And the deployment of that $40 billion is really where banking intersects with geopolitical strategy.
How so?
Well, analysts consistently pressure executives to use excess cash for stock buybacks, essentially purchasing their own shares in the open market to reduce the supply and boost the stock price.
Sure.
But Diamond was fiercely resistant to this as a default strategy. He explicitly rejected that common Wall Street phrase, returning money to shareholders. He argued that authorizing a stock buyback when the stock is trading at 3 times its tangible book value is not a passive return of capital. It is a highly aggressive investment decision.
Because buying a dollar's worth of the bank's actual tangible assets for $3 on the open market is a massive premium.
Exactly.
So buying back stock when times are this good and prices are this high is basically like hoarding expensive umbrellas during a drought instead of using that money to build a well for the coming years.
That's spot on. And Diamond sees unprecedented structural demands for capital on the immediate horizon. If we connect this to the bigger picture, the bank is positioning itself to finance macroeconomic shifts that completely eclipse standard business cycles.
Like what?
We're looking at global AI infrastructure capital expenditures that are projected to skyrocket from $400 billion to over $1 trillion annually.
Wow.
We are witnessing rapid global remilitarization, which requires massive credit facilities for defense contractors and aerospace manufacturing.
Right.
And we are seeing a fundamental restructuring of global trade supply chains, forcing the onshoring of semiconductor plants and heavy manufacturing. Add to that enormous persistent government deficits running at 4.5 to 5% of GDP.
Jeez. So all of these global forces are aggressively competing for the exact same pool of capital.
Yes, all of them.
So rather than shrinking their share count at a premium, they are deploying that capital organically to capture those massive global growth vectors.
Exactly. And a prime example of this organic deployment is their international consumer strategy.
Oh, right, the UK expansion.
Yeah. When they decided to expand the Chase retail brand into the United Kingdom, they didn't just lease prime real estate in London and try to build brick-and-mortar branches.
Right, because navigating the diverse legacy regulatory regimes, the fragmented labor laws, and the varied languages of the European market with physical branches, that would be an operational nightmare.
Absolute nightmare. Instead, they utilized their excess capital to build a cloud-native digital bank entirely from scratch.
Wow.
By bypassing the physical overhead and the spaghetti code of legacy European banking mainframes, they created a highly agile digital platform.
And it's working, right.
Oh, yeah. Over the last 4 to 5 years, that strategy has acquired roughly 3 million customers in the UK, and they are actively pushing the infrastructure into Berlin with the long-term vision of establishing a pan-European banking powerhouse.
The unit economics of a branchless digital bank operating across multiple sovereign borders are incredibly powerful. Once the core digital ledger is built, adding a new customer in Germany or Spain costs a fraction of what it takes to service a physical account.
Exactly. They are also iterating on the deposit side with a smart cash tool they are testing for consumer accounts. It's designed to seamlessly capture investment business as the velocity of money changes in the economy. They are relentlessly building.
But deploying $40 billion across global digital markets, AI infrastructure, and international supply chains, it isn't just a logistics challenge. It exposes the bank to a massive, interconnected web of international credit and regulatory risks.
It does. And they are highly attuned to the fact that operating at this scale requires an impenetrable fortress around that capital.
Which means we need to examine their defensive posture, because beneath the surface of this booming revenue, the executives noted a mild but distinct deterioration in the broader credit markets.
Yeah, it's not a systemic panic yet, but the edges are certainly fraying.
Right. They highlighted weaker covenants, meaning the strict rules and financial boundaries borrowers typically have to adhere to are being loosened by competitors who are just desperate to win deals.
Yeah, they are seeing highly optimistic bordering on fictional revenue projections in loan applications. And most notably, they're seeing a rise in PI, or payment in kind.
Explain PI really quickly for those who might not know.
Sure, payment in kind is a critical barometer for credit stress. When a corporate borrower lacks the actual cash flow to make their monthly interest payments, a PI arrangement allows them to simply roll that unpaid interest into their principal debt pile.
Right, so it technically avoids a default today, but it aggressively compounds the borrower's total leverage.
Exactly. It just kicks a much larger, heavier can down the road.
Which is a massive red flag for the credit cycle. And the bank is actively walking away from highly lucrative deals that exhibit these exact vulnerabilities.
Right. We talked earlier about the massive rush to finance data centers.
Yeah.
The executives confirmed they have actually passed on several major data center deals because upon deep inspection, the local power grid supply logistics were unstable, or the long-term tenant contracts lacked sufficient guarantees.
So they are perfectly willing to let their competitors absorb that physical and financial risk.
Absolutely. But while they can independently manage their credit exposure, their deepest frustration stems from risks imposed upon them by regulators.
Ah, yes. Demon was remarkably blunt about the proposed Basel III endgame and the GSIB, the Global Systemically Important Bank Surcharges.
He was, and his primary grievance centers on the mechanics of how regulators are mathematically double-counting risk.
Explain the mechanism behind that double counting, because the disparity they cited is just staggering. Diamond pointed out that under the new frameworks, the bank is forced to hold $80 billion in market risk capital, despite the fact that their absolute worst historical quarterly market loss was only $1.4 billion.
All right.
How do regulators justify demanding $80 billion in frozen reserves for a $1.4 billion historical reality?
What's fascinating here is how the inflation of that capital requirement actually happens. It happens because the regulatory formulas stack worst-case scenarios on top of each other, rather than analyzing holistic risk.
What do you mean?
The framework applies a heavy capital penalty for standard operational risk, right? Then it adds another isolated penalty for market volatility, and then applies a GSIB surcharge simply because of the bank's massive scale.
So it ignores the fact that a bank's diversified scale often acts as an internal hedge.
Exactly. By overlapping these isolated formulas, regulators artificially inflate the risk profile, forcing the bank to lock up $80 billion.
And that is $80 billion that cannot be lent out to build new factories, fund small businesses, or invest in digital infrastructure. It is essentially paralyzed.
Diamond was pleading for intellectual honesty in the math. He said if regulators simply want banks to arbitrarily hold 10% more capital to feel safe, they should explicitly mandate a 10% hike.
Right. But manipulating the complex risk formulas to quietly achieve that end goal distorts the entire lending market, which raises a really vital question.
Go for it.
Are these sweeping, overlapping regulatory frameworks actually making the financial system bulletproof for you and me? Or are they just creating the illusion of safety through an endless maze of compliance paperwork?
Diamond strongly asserts that complex paperwork does not equal safety. He pointed directly to the recent collapses of Silicon Valley Bank and First Republic to validate his argument.
Oh, right.
Those institutions didn't collapse because they lacked highly complex derivative reporting or sufficient bureaucratic oversight. They failed due to catastrophic mismanagement of basic interest rate risk.
Yeah, they engaged in the classic fatal flaw of banking. They borrowed short-term deposits and locked that money into long-term bonds right as the Federal Reserve began aggressively raising interest rates.
Exactly. When the bonds lost value and depositors panicked, they were instantly insolvent.
So Dimon's point is that adding layer upon layer of overlapping market risk formulas to the largest banks does absolutely nothing to prevent catastrophic boardroom mismanagement at regional levels.
Right. If regulators had simply focused on fundamental safety and soundness audits, examining the basic duration risk of those bond portfolios, those failures could have been entirely prevented.
While navigating this overlapping matrix of aggressive global capital deployment, fraying credit markets, and hostile regulatory frameworks, it requires an incredibly specific type of leadership.
It does. Which brings us to the highly scrutinized succession planning at JPMorgan Chase.
Right. With the upcoming retirement of Marianne Lake, the board recently elevated Troy Rohrbaugh and Doug Petno to co-presidents of the Commercial and Investment Bank.
And it's a very deliberate structural move to stress test their ability to run the entire enterprise.
There was also a quick, somewhat amusing moment on the call where they corrected the record regarding Troy's specific trading background.
Oh, yeah.
They noted he cut his teeth as an options trader, dealing with the complex, nonlinear math of derivatives, rather than as a foreign exchange spot trader. The distinction is a big deal in the cultural hierarchy of trading floors.
It absolutely is. But while the immediate organizational chart shifted, the timeline for Diamond ultimately stepping down remains pretty fluid. He reiterated that his departure is still several years away, leaving the final timing entirely to the board's discretion.
What was truly revealing, though, was his exhaustive breakdown of the specific traits required to manage a 300,000-employee global entity.
Yeah, he made it clear that raw intellect and analytical dominance are merely the baseline prerequisites.
Right. The role requires a profound level of emotional intelligence, grit, and what he termed being a true culture carrier.
Because a culture carrier cannot just be an elite investment banker who only prioritizes the mergers and acquisitions desk.
Right.
The leader of this institution must possess the operational empathy to comfortably walk the floors of a regional call center or a data processing hub, understand the granular challenges of those frontline workers, and then immediately pivot with the flexibility of mind to negotiate sovereign debt with global prime ministers or debate API infrastructure with tech CEOs.
It sounds less like being a traditional banker and more like being the mayor of a highly complex 300,000-person digital and physical city.
That's exactly it.
You have to understand the systemic importance of the sanitation department just as deeply as you understand the zoning laws for the skyline.
Beautifully said.
So what does this all mean?
Well, the synthesis of this entire Q&A session is that the bank is operating from a position of immense fortified strength, but they are hyper-vigilant about the fragility of the macro environment.
Right. They are maximizing their revenue engines in a risk-on market. They are deploying a ruthless, customer-centric strategy toward AI implementation, and they're preparing their balance sheet to fund global remilitarization and supply chain shifts.
Exactly, but they are executing all of this while actively defending against aggressive regulatory overreach and walking away from degrading credit deals.
And every single one of those macro-level boardroom decisions filters directly down into your daily life.
It does.
Whether they decide to finance a sprawling data center grid in your state, how they optimize the AI processing your mortgage application, and how they allocate $40 billion in excess capital, these mechanics dictate the interest rates on your credit cards, the speed of your banking app, and the fundamental liquidity of your local economy.
Before we wrap this deep dive, there is one final, incredibly striking data point buried in these transcripts that completely shatters a major media narrative right now.
Oh.
Well, we are constantly inundated with the concept of a K-shaped recovery. The widespread narrative that the wealthy are thriving and accelerating on the upward arm of the K, while the middle and lower income classes are steadily collapsing on the downward arm.
Right. It's the dominant economic talking point on almost every financial network right now. But you're saying the bank's internal blueprints contradict this.
Completely. The executives explicitly stated that their proprietary internal data, which monitors the daily spending habits of millions of consumers, backed by recent Federal Reserve analysis, simply does not support the K-shaped narrative.
Wait, really?
Yeah. According to their unprecedented view of the transactional economy, consumer spending is surprisingly robust across all income segments.
So the data isn't showing a massive structural fracture between the wealthy and the working class?
No. They noted that delinquencies on loans and credit cards are actually coming in lower than their internal models projected across every single FICO credit score band.
That's wild.
The economic heterogeneity data is not reflecting the sharp, catastrophic divide that dominates the headlines. Despite inflation and high rates, the consumer base across the entire spectrum remains fundamentally resilient.
Man, that is a fascinating collision between raw data and public perception.
Isn't it?
So here is a final thought for you to chew on as you navigate your week. Look closely at your own financial environment, your local businesses, and your community. Is the global economy truly defying gravity, propped up by a remarkably resilient consumer base, just like JP Morgan's internal data suggests? Or is this robust spending simply the final, echoing calm before the broader credit cycle inevitably shifts?
It's a great question.
Keep your eyes open to those mechanics, because whether you are actively watching it or not, the engine room of the global economy is always humming right beneath your feet.